In this lesson, we are going to learn about what are stock and flow variables, concept of real flow and money flow, the circular flow of income in 2, 3 and 4 sectors of the economy. What are leakages and injections? Why should we study the circular flow of income? Let us first understand what are stock variable and flow variable. The word stock means the goods kept on a shop or warehouse and are available for sale on that particular point of time. Like the quantity of water in a tank at a particular point of time will be considered as a stock variable. Similarly, stock of goods in the shop as on the 15th of August, 2020, or the population of Maharashtra as on the 1st of January 2020 are the example of stock variable. Flow means moving continuously. Similarly, flow variables cannot be measured at a particular point in time, but are measured over a period of time. For example, the amount of water which is flowing into the tank from the tap per minute is a flow variable. In the same manner, the net investment will flow continuously during a period of time, and so it is considered as a flow. Other examples include production of goods in December, the national income of India in 2019. The period of time here can be a week or month or even years. Now, let's move on to learn what is the circular flow of income. Consider that you are on an island. There is no government, no banks and no trade. There are only households and firms. The households are the owners of the factors of production and consumers of the goods which are produced by the firms. The households provide the firms with factor services which include land, labor, capital, and entrepreneurship. And the firms, in turn, pays the households in the form of rent, wages, interest, and profit respectively. The households then spend the entire amount earned on consumption of the goods and services. It is assumed that there are no savings as there are no banks. This is the circular flow of income. It demonstrates how money moves through society. Money flows from producers to consumers as factor payments and flows back to producers as payment for products. This flow of income continues as production is a continuous activity due to never-ending human wants. In short, an economy is an endless circular flow of money. In this, the flow of factor services from households to firms and the subsequent flow of goods and services from firms to households is called real flow. On the other hand, the flow of factor payments from firms to households and the corresponding flow of consumption expenditure from households to firms is called the money flow. Thus, in a two-sector economy, total production equals total consumption, factor payment equals factor income equals consumption expenditure, and real flow equals money flow. However, in the real world, this is not the case. The households tend to save some of their income and firms tend to take loans to expand. The financial institutions or the banks make this possible. The savings of households accumulated in financial markets are utilized by firms for investment purposes. So, the circular flow continues. That is the basic form of the model, but actual money flows are more complicated. In the real world, all countries have government. Now, let us study what is the role of government in an economy. Government collects taxes from both households and firms. It makes transfer payments to households and also provides subsidies to the firms. Government also uses the goods produced by the firms. Hence, it makes the payment for these goods and services to the firms. Government uses the households for the factor services. For example, people who work in government offices get wages in return. Hence, there is a flow of factor payments from government to households. Government also saves and borrows money with the help of financial institutions. Let us now learn about the four-sector economy. Countries interact with other countries in the form of trade. Countries export and import goods and services as per their requirement. Firms and households pay to the foreign sector in the form of payments for imports. Firms also export their goods and services and receive receipts for the same. The foreign sector also makes payment for factor services to the households. Many people from one country go abroad for jobs. They send back their hard-earned money back to their families residing in their home nation. This net transfer of money is termed as net transfer payments. The money keeps revolving around from one sector to another. This circular flow of income is complete and continuous. We have seen how money keeps revolving from one sector to another in the economy. However, there are leakages and injection in the economy for various reasons. Leakage means money going out of the system, and injection means money coming into the system. Let's understand the concept of leakages and injections. Leakages refer to withdrawal of money from the circular flow. It is the amount which is not used to spend on consumption of goods and services. For example, when households save a part of their income. Thus, leakage reduces the flow of income. Examples of leakages in different types of economy. In two-sector economy without financial market, there is no leakage as the whole amount earned by the households is completely spent on consumption. In two-sector economy with financial market, the extra money saved by the households and a portion of the profits saved by the firms reduce the flow of income. Hence savings result into leakage. Similarly, in three-sector economy, people and firm pay taxes to government. Hence, leakage happens by saving in taxes. In case of four-sector economy, household and firm pay for imports. Hence leakage happens by saving, taxes and imports. Let us now understand about injections. Injections refer to the introduction of money in the circular flow. When households and firms borrow extra money from banks and spend it on the consumption of goods, it is called injections. It increases the flow of income. Examples of injections in different types of economy. Two-sector without financial market. There is no injections. Two-sector economy with financial market. Investment from financial institutions. Three-sector economy. Investment plus government expenditure. Four-sector economy. Investment plus government expenditure plus money earned out of exports. Let us revisit our learning in this chapter. Circular flow of income. The interdependence among different sectors. How all the sectors are complementary to each other and how this keeps the economy intact. How the equilibrium is maintained in the economy. We also understood about various leakages and injections.